Good morning, fellow investors. Felix here from Hong Kong. Great to have you on the call. This is the tapering day. Is it or isn't this? But this is really what we're about to find out in about 30 minutes. Jay Powell will speak, and it will be interesting because this is really what the market is hinging on. I've got on the screen here futures. At the moment, the market is looking pretty rosy, everything looking green. People seem to think that we might get tapering, but perhaps more slowly than people anticipate. My view on this is that he isn't going to give us a date on tapering. My view is that he is going to give us indications and of what might happen and when it'll happen. But bear in mind also the guy is up for re-election essentially, or renomination early next year. So he is, I think, intentionally or unintentionally, subconsciously, just going to drag this out a little bit. So perhaps we're going to get tapering in December, and that way we won't really see that impact till, say, February or March or so in the real economy. These things take a couple of months to kind of sink in. But at the moment, things are looking pretty green here. Let me show you also on the chart pre-market. Everything is up basically. Absolutely, the whole market is in the green in terms of tech stocks. Well, not everything. NEO down 0.08%. Ride is calming down a little bit on the excitement of having a new CEO and so on. But overall, we're looking pretty healthy here going into it. The 10-year bond yield is also down ever so slightly, 0.5 percentage point, which is, indicative of the market not being particularly worried about inflation. I do have Bloomberg here in the background, but we don't need to listen to every single Fed president. This is this Kaplan or is this Bullard? I never remember which one's which. Anyway, this is one of the more hawkish chaps who's talking at present. Stefan, Glenn, Jan, Baron, Adam, Roti Boy, great to have you on the call here. We can talk about Baron is throwing up a little bit perhaps before we really dig deep into the Fed about this eviction moratorium. My view on that is perhaps a little bit of a political one. I think if governments want to stop evictions, they need to pay the rent. I think stopping evictions is appropriation. I think it's equivalent to taking away property rights, and it's therefore sort of a step towards communism. I don't think many people favor that. So I actually think the court's decision here is the right one. I think the policy has a good intention, but it's executed the wrong way. The government should pay rent directly to those landlords and therefore stop evictions, do it through a welfare channel rather than banning something. It's the equivalent of someone showing up at your door and saying, excuse me, I'm going to use your car for the next 6 months. I'm not going to pay you for it, but I'm just going to take it. Like, you just can't do that in a civilized society where property rights are respected. It's not just the US that did it. A lot of Europe's done it. UK have done it. And I do think this will all end in court. And I think governments are going to have to pay out some serious money here to landlords. And it's landlords big and small as well, right? Not every landlord is some big greedy corporation. There are lots of people who saved up for years and years and bought a little property and are renting it out, or leasing it out rather. So in my book, it doesn't make it any better or worse because somebody's big or small or has lots of money or no money. The fundamental rule has to be, if we live in a capitalist society, that property rights are respected. Otherwise, what's the point? What's the point in it all? We might all as well just live off welfare. The symposium, Eric, I think the chat has started, but what we're seeing at the moment, basically, and I can show it to you here on Bloomberg, they are interviewing some of the Fed presidents, but they're all saying not a great deal so far. I listened to one just. So once we get Jay Powell on the screen, I'll definitely turn that up for us to listen to, because that's really what we're here for. Because he represents the kind of consensus, right? He can't go out and say, this is my crazy view or that's my crazy view. He has to come to some sort of agreement because he's the leader. He's the one who's chairing the whole thing. So it's going to come up in about 20 odd minutes or so. Eric thinks today is going to be a good stock shopping day. Well, strangely enough, pre-market, things are looking pretty good. Cyrus hopes it's a red day. Let's see how Powell can ruin my day today, Philip. Welcome. Too many big programs are ending at once. Enough sponging of the government job. hit the like button, says learning to fly. Well, that's one thing I definitely agree with here. So here is, on the chart is Bullard. Let me turn him on for a second.
So, yeah, I think the key word is optionality for 2022. We want to, or I would like to anyway, taper now and get it finished by the end of the first quarter. And then at that point, I think we could assess what's happening in the economy with respect to inflation. By that time, we'll have many more jobs reports, and it certainly looks like they'll all be strong to varying degrees. Unemployment will tick down with a 4 handle at that point, and then we'll be able to see in the first half of 2022 if inflation is moderating or not. And if it's moderating, then we're in great shape. And if it's not moderating, then we might have to be more aggressive. So I think that optionality has a lot of value right now. I think the purchases don't have much value right now. So it seems like the trade-off is just right to me. Let's phase out the purchases and let's give ourselves some breathing room in 2022.
Well, okay, so he's basically, he is the sort of hawk. He's basically saying, let's taper now, let's get it over with by the first quarter, and then let's start looking at interest rates. That's really what Bullard is saying here. But everybody knows that this St. Louis chap is a pretty hawkish guy. He doesn't necessarily represent what everybody's saying out of all the Fed presidents. And if you read the minutes from the last meeting, it was pretty even keel. I mean, there were people who were saying, let's be cautious, let's see what happens with COVID in autumn. Let's fill that employment gap, which is still very significant. And then there are those like this chap here who's a super hawk. And Desmond, thanks. You're welcome to the chat here. The hawks seem to get 3 times as much airtime as the doves. And that's, I think, just the way the media likes it. It's a more interesting and exciting story here. So it'll be interesting to see what happens in literally about 15-20 minutes when Jay Powell actually takes the mic. He's typically, I've read through a few of his past speeches over the last few years, typically he sort of goes over a little bit of history of what the bank's been doing and what the previous chairs have done, and it's sort of meant to be an overall policy review rather than sort of the key decision maker. But what they should give us is guidance on how they determine this policy. At what point do they say we taper? At what point do they say we might even look at interest rates? I think Jay Powell is going to try and avoid the word interest rate because he knows what that would do to the market. Tapering is one thing, removing that bond purchasing is one thing, tinkering with interest rates is a whole different thing as well. Glenn thinks the Hawks get more airtime to make Powell's comments more dovish. Do you think it's that organized, or does this chap Bullard just like to be on television? He looks to me like he rather enjoys being on screen. So you might well be right there, though. You might well be onto something. And Adam thinks that the market has already priced it in. Well, the pre-market is certainly agreeing with you here. Let me show you. This is the futures, everything looking bright and green. Volatility is down, and then pre-market, even the education stocks are up, which is just insanity in my view. But Tal, GameStop, Workhorse up, JD is up, Palantir up almost 0.7%, Tesla is up, Square is up, Facebook's up. Really, the only thing that's substantially down is Baba. And what's all that about? I shared that earlier on the Discord with you guys. So we were talking about that before this call, and I'll pull it up for you here if you're not already on there. And if you aren't on there, think about joining us. It's a marvelous community. You can get there through the Patreon program. The link, of course, is below. So this is really what this is all about. That hang on, where did I post it? I posted it here somewhere. Maybe I posted it in the Chinese stocks. Anyway, there is more regulation now. That's basically it. Here it is. No, that's not it either. Okay, it's on here somewhere. There's a lot of stuff on here. Here it is. Baba reportedly invests in L4 autopilot. Well, that's good news. That's not what moved it. It's this one here. The Chinese authorities are seeking the opinions on internet info service algorithm recommendations. So this is all about, is Alibaba allowed to recommend search results in their search algorithm? And because that's what they do, of course, right? They suggest those shops on their platforms who pay the highest fees and pay the most advertising. And it does, of course, somewhat manipulate search results. And therefore, if this does get regulated or prohibited somehow, it'll hit their bottom line, because it means they will no longer be able to favor their top merchants as much as they are at present. So learning to fly says the market is open. All right, let's have a look then at what the actual market's doing. So the market's still looking pretty green. Palantir up 2.2%. That's wonderful. We are back up to $25. So I really hope that $25 is our new support line here. I think we were there 2 or 3 days ago before this nonsensical New York Post story, and now we're back up there. That's definitely good news. Amazon's up. QQQ is up just a fraction here. Neo down a little, but not substantially. Microsoft down 0.5%. So that's probably just money moving out of the more safe tech spaces into the more kind of attractive, well, in a sense of higher risk tech ones. And then, well, yeah, Baba down, Lordstown down. That's just kind of crazy volatility there on Lordstown on the news that they have a new CEO. It went up like mad yesterday. So some people taking some profits. August, did you miss anything important? Yes, August, we've talked about all the important stuff and we're not going to mention it ever again. No, seriously, we've just had a peek at what some of the Fed Kaplan's talking about here. I know I haven't got the sound on. He's just talking around in circles because he's basically saying, I want to get this over with. He means tapering by Q1. And then I want to look at optionality. And with that, he means interest rate hikes. So he's a pretty hawkish guy. And Philip, yes, you are right. There is a big Tesla story out. Tesla has filed in Texas to become a direct supplier of electricity. And they're building those 2 massive battery storage units or whatever you want to call them at the Tesla factory and just near it. So that's going to be interesting. They could become... It's not just about selling electricity, it's about getting more credits, right? And the CEO of this new division is the lady who's in charge of all the electricity regulatory credits. And I think she's made Tesla something like $3 billion so far. So a very interesting move there from Tesla. Rudy is saying China plans to ban overseas IPOs for tech firms with data security risks. Rudy, I think that story is related to, there's a new piece of legislation out and they've clarified basically you've got to do 2 things if you want to list overseas as a Chinese company. 1, you got to comply with all the laws and regulations, and 2, you have to comply with a sort of national security data kind of regulation. I don't think that's anything particularly onerous, actually. That piece of legislation, the draft I've seen of it, did seem fairly standard. It just means you got to protect your data and you got to get sign off from the regulator here. So I don't think they're I don't think the intention is to prevent IPOs. The intention is to prevent bad IPOs. And they're looking at Didi here, who really screwed the whole sector and the whole reputation of Chinese equities. I think that's really what this is about. It's kind of the opposite of what a lot of headlines suggest. They want to only get good companies listed and they want to get the bad ones not to damage the sector. Let me go back here to what Bullard's saying. Let's turn him on.
In the United States, it wouldn't be as smooth as it has been in other places for the money market fund and a variety of other reasons. But you've talked about the need to get interest rates up so that we can use that and combat the next downturn, have some ammunition. If we cannot get rates substantially higher, how do you foresee asset purchases factoring into future stimulus?
Yeah, they've become a standard part of the toolkit, and we used it after the global financial crisis, pioneered by former Chairman Bernanke, and kudos to him for that. And then, when this crisis came along, we went right back to it with considerable success, I would say, in the March, April 2020 period, where we really were staring at a possible depression and a possible financial crisis. And I thought Chair Powell did a excellent job during that time frame in getting us into a policy that avoided the financial crisis that could have occurred on top of the pandemic, and put us on very good footing. It wasn't too long after March, April that financial stress measures came way down from very high levels, and we got back to normality, at least with respect to financial markets. So asset purchases are part of the toolkit, and they're here to stay. But right now, I don't think they're helping us that much, and they may be causing harm, especially in housing, where we don't want to feed into an incipient housing bubble. We got into a lot of trouble in the mid 2000s with housing, and I'm not too anxious to try to see that happen again. So I think that just the time has come to end these purchases.
Okay, I think we kind of get the drift of what he's talking about. He's probably the most hawkish of the lot. Desmond says he dislikes bright lights. He's probably usually surrounded by lots of paper. He sits in a basement. Wasn't it supposed to be a bloody red day, says 8080. Well, wait for Powell to speak, 8080, before we come to a conclusion on what's going to happen here. But you are completely right. The pre-market is looking pretty green. All the futures are looking absolutely marvelous. Everything is up 0.25%. Volatility is down. VIX is down. And obviously the markets is open. Palantir now up 3%, which is brilliant, 25.65. And most things looking pretty green here. A couple of stocks down 0.5% or so, but no major movements here, with the exception of Baba, really, on the news of potential regulation affecting their algorithms. Desmond, is OJ down? Oh my God, that is serious. Orange juice is down 0.5%, so that's tough. What time is the speech, Rudy? It's literally in 14 minutes. So we just opened here a little bit earlier. We've listened to a couple of other Fed presidents talking and sharing their views, although so far they've only interviewed the really hawkish guys here, who are basically all saying the same thing. Taper, taper, taper. Now, if some people are confused what tapering really means, I totally appreciate that. It basically means that... here's Tom with a crazy headline: bans US IPOs. No, Tom, that's not happening. But okay, I'll have a chat with Tom on that one a bit later. What is really happening here is that the hawks getting all the airtime, and they are basically saying let's get this over with. And the tapering is basically means the $120 billion in bond purchases that they do every month, that they want to fizzle out. They want to reduce it. They might reduce it by 10 billion or by 15 billion a month or so. That's tapering. Now, in reality, they are also reinvesting the existing bonds that are expiring, because they buy a lot of short-term bonds. So say they bought a short-term bond 3 months ago, that's going to expire this month. They're going to reinvest that money. So actually the amount of money they put into the market has sort of ballooned fairly substantially. Rudy says Tom Nash is anti-China, period. Yeah, I think he sort of is. I think he also just sees it as a pretty easy punching bag. So I don't blame him. Yeah, he's certainly not open to the sector of China. I'm totally with you there. Is the market not taking the Fed seriously, says Sakin there? Well, let's wait till Powell speaks. What these guys are saying here is what we know about. We know that Bullard and Kaplan and these guys are hawkish. We are waiting for Powell to speak. That's what matters. His speech essentially represents the majority, or everybody, in all the Fed shares and all the Fed voting chairs, at least. So Desmond says Tom leans hard into the anti-China for the YouTube algorithms. Yeah, he knows. He says I'm Russian. I mean, Russia is not communist, just like China isn't communist. I know they use the word, but I actually think what was communist was, and I know I'm going to get some stick for this, but I think the eviction bans were, because you can't just stop people from using and enjoying their property. It's private property, and it's called private property because we respect it. And if you restrict what people can do with it, and if people don't pay you rent and you can't get rid of them, then the government wants to stop that for welfare reasons. The government needs to pay the rent. The government just can't just ban it. So I think that makes a lot of sense. And, there's going to be a lawsuit there to get the government to pay for what's going on, I think. So here's the Morgan Stanley equity strategist. Let's have a listen in for a sec.
If you actually look at where inventories are today, ex autos, you actually see inventories above the long-term trend. And so what we think is going on is pretty simple. We had an exogenous shock to demand, both on the downside and then the upside. We're now above trend. And so demand is overstated. And that's making people think inventories are too low. When demand normalizes, which is what we think it will do, that's not a recession, by the way, it's just a normalization of where demand is going to be longer term, the inventories will all of a sudden appear. Right. And I think you have a very good example of that already in the housing market, Tom. You've seen, obviously lumber prices rocketed up.
Yep.
Then, of course, you've got inventory, appeared magically, and then, lumber prices adjusted sharply lower. And I think we're going to see that in some other areas. One area, we've recently downgraded DRAM stocks, in semiconductors. Everybody's talking about supply shortages, and well, that's an area we think where pricing is going to be weak because supply is actually going to be pretty good ultimately.
Mike Wilson, you have the advantage of Morgan Stanley fixed income, the dynamics of it all. The fact is there is a wall of unimaginable liquidity. When the facts change, how will our liquidity change?
I think, you spent a lot of time this morning talking to all the Fed governors, and we're going to hear from Chair Powell shortly. The economy is very different from the markets, as you know. And, we clearly have had a robust recovery. It's been spectacular. We've also had a robust policy support. And that policy support is about to become less robust. And that will have probably a bigger impact on financial markets than it will have on the economy. I don't think there's any doubt that we should be tapering at some point soon. The economy does not need emergency monetary policy. I think the governors agree, and they're going to do that. The question is, what's the reaction on prices? I think we're already seeing it, Tom. Throughout this year, we've talked about this rolling correction. We've seen the weaker asset prices actually correct significantly around the world and even in the U.S., and that's the way the market's dealing with it. The big question is, will there then be a broader correction kind of at the, say, S&P 500 level? We think there will be. It's a correction to buy, but we think that, this is part of the mid-cycle transition. The Fed is moving away from maximum accommodation, just like.
All right, let's silence for that for the moment. Well, interesting what he says. The correction to come is a correction to buy, right? So Morgan Stanley is still pretty bullish, as are all the investment banks really, with end of year S&P 500 targets somewhere between 4,600 to 4,800. It's what most of them think is going to happen. So I don't think this is anything massively to worry about, and I know there will all be these crazy headlines because it's what's required to get people to click on things nowadays. But I actually think they're going to do this in a pretty moderate way. Now, Glenn was asking, what is going to happen? Are they going to loosen the reserve ratio requirements to offset the taper, Glenn? No, I don't think so. I don't think they do want to do that. I think they literally want to restack their kind of toolkit. So at the moment, it's all out there in the market, and they want to get it back so they can use it again in a couple of years' time when they feel like they'll need it. So I sort of don't think that is. And Glenn, you're completely right. Lumber went to the roof, and then it's come crashing down. And everybody talked about it when it was up, and no one's talking about it when it's down. That's always the story, I find. And Trishan, yes, Palantir is above $25, which is just marvelously exciting, isn't it? So Palantir here at $25.49 at the moment, a really nice kind of place to find a new bottom. Market overall broadly very, very green. Volatility is down. QQQ is up. S&P is up. Everything is up basically. Although the Nasdaq was up 0.25%, now it's up 0.16%. So the growth stocks are feeling a little bit itchy. They're feeling just a little bit uncomfortable with what's going to happen here. So let's see what's to come here. JD is flying, says Rudy. Okay, really? I haven't seen that yet. Where's JD? JD up, 0.4%. Is that flying by your measure, Rudy? I look at normally more than a percentage point. Tristan is asking, do you think the geopolitical stuff, Afghanistan, etc., is tailwind for Palantir? Well, I mean, it certainly doesn't hurt when there is going to be more expenditure on things like drones and special forces. I think that's the way the US is going to go. I think presidents will be very cautious to deploy the amount of troops they put into places like Iraq and Afghanistan for quite some years. It's not a popular move. It doesn't achieve all that much in the long run. So I think it's going to be more about drone strikes and special forces, and both of which are, of course, powered by Palantir. So yes, I think in some sense that is good news for Palantir here. Really, okay, you're talking about JD has gone up quite substantially, yes. And Kathy has bought JD. She's bought JD Logistics as well, which is probably helping somewhat momentum here. And the drug boss says the FBI uses Palantir. Yes, well, we certainly all know that since the New York Post wrote about it. So again, is it an advert? Perhaps it is, to make more people realize that they are using it. I mean, a lot of people, I think, know by now, but it's, let's have a quick look at the 10-year bond yield, 133. So it's come down some more, which is surprising, really. Let's look at all the bond yields. So the short-term ones are shooting up. By the way, today, 60% of all the 10-year bond yield options are expiring. So that's a pretty major day in terms of bond expiry, options expiry rather. But yeah, the long-term ones are all down. So the bond traders are not believing in inflation. Now, if you are wondering about economic terms sometimes and what the Fed does and what they say and which economic indicators are important, I do teach all this stuff. I used to be an economist. I was an investment banker for a little while as well and a corporate lawyer. If that's interesting to you, check it out. It's down in the Master Stocks course down below. Go to my website. There's a link below in the description as well. Check it out. There's a 29% off coupon. And if you want to ask me any questions on that or anything else, drop me an email to felix@goatacademy.org. I'd love to hear from you, and I'll definitely answer you. Merlin, did you see what Tom just posted about Chinese stocks? Yes, it's a load of nonsense, Merlin. I just saw it pop up on the screen. What he's basically saying is, we talked about this 3 days ago, I'd say. You know, that's you get the news here first. Maybe that's where Tom heard it. Just kidding. I like the guy a lot. He's a really, really good guy. But, you know, he puts out videos from his point of view or for whatever reason. And what China has done is that they've put out a regulation that says if you want an IPO overseas and you're a Chinese company, you got to tick two tick boxes. One, you have to show that you're complying with all laws and regulations. There's going to be this sort of pre-IPO audit. And second, there is a sort of national security piece of legislation. And within that folds most tech stuff. And you have to essentially get sign off on that as well. Put that into perspective with the vice chair of the Chinese SEC endorsing VIE structures last week. Put it into this perspective that the same Chinese SEC also said last week that we want to make legislative changes and work on the audit cooperation with the US. They actually want to fix the problem. They don't want a repeat of Didi, who listed in the US. The US regulator has no way of knowing whether or not they comply with Chinese law because the SEC doesn't understand Chinese law, and they didn't have to ask anybody in China. And then they get investigated, and then, you know, something hits the fan, right? So that's what happened, and they want to prevent that. And how do you prevent that? Well, you make them go through all the checks and balances before they go and talk to the SEC about listing. And I think it makes sense. I think it's good for investors. It's good for the reputation of Chinese stocks. But of course, the media is twisting it into exactly the opposite now. So, Desmond, I completely agree with you. I think the IPO reform rules are important. It makes sense that the domestic regulator goes through all the legal checks with the company because the SEC can't do it, right? They haven't got access to the Chinese documents or laws, and they don't understand it. They don't read Chinese. They're not there to like poke around, and they haven't really got a sort of legal mandate to do that. They basically get presented with a document prepared by lawyers and accountants in which it says, yep, we comply with the law. But they have no way of really checking or knowing whether that's right. And the Didi story certainly is enough warning for this to kind of get into place. Guys, would it be too much trouble if I asked you to smash that like button? It's a little button. It's red, and you can press it, and it would tremendously help me. It would mean the world. I would truly appreciate that if you did. We have literally here less than a minute till Chair Powell speaks. So sit on the edge of your seat, grip onto something, and see what happens to the market while he's talking. And the drug wall says we do need some likes. Yes, we got 70 now. I think we could get to 100 pretty easily here. I would only require about 20% of people on this call to hit it. And Desmond, I'm totally with you there on the Chinese stocks. Didi did indeed break that straw. Break the back. Breaking news, an old man is going to talk. Indeed, an old white man is about to talk. Will you save a bunny rabbit, says Noah? Yes, I absolutely will. I keep donating, guys, about $1,500 so far or so. I'll do it at the end of every month. $75 likes now, 89 likes now. I think we can get that to 100. So literally, we are waiting here. Hope Meng is saying, do you think AMC and GameStop apes are going to lose money? Look, some people lose money, some people make money. It is a very, very volatile gamble to be in. So yeah, I would be very cautious with that. Some people made a lot of money, and I'm very, very happy for them. But it's definitely the most risky thing you can pretty much bet on. They're trying to scare people so hard, all using words like imminent. Yes, I know everything is imminent. This is going to be a war on bond purchases. I think that'd be a good way of putting it. Everything is a war nowadays, isn't it? The smallest thing. So, Hope Meng, thank you very much for the like. And the Drogba says some people lost their life savings. Yeah, and that's really a shame. I mean, I think the whole thing about investing is protecting the bottom line. That's what it's all about.
My view is that the substantial further progress test has been met for inflation. There has also been clear progress toward maximum employment. He goes on to say, at the FOMC's recent July meeting, I was of the view, as were most participants, that if the economy evolved broadly as anticipated, it could be appropriate to start reducing the pace of asset purchases this year. The intervening month has brought more progress in the form of a strong employment report for July. Now, he goes on to say they'll be watching the data carefully, but it does seem to put him in the camp of those who are ready to start tapering. He doesn't give a direct signal, but that's a pretty strong lean in the direction of starting to cut back on QE. He does note that labor market conditions are improving but turbulent, and the pandemic continues to threaten not only health and life, but also economic activity. Earlier today, we got a higher PCE inflation rate. Powell continues to stick to the idea that it is going to be a transitory effect. He said because inflation at this point is not broad-based. It's a higher inflation. Items are moderating. Long-term inflation expectations are low, and globalization continues. All right. So now we will hear from him, the chairman himself.
Here is Chairman Powell.
COVID-19 pandemic. This shock led to an immediate and unprecedented decline, as large parts of the economy were shuttered to contain the spread of the disease. The path of recovery has been a difficult one, and a good place to begin is by thanking those on the front line fighting the pandemic. The essential workers who kept the economy going, those who have cared for others in need, and those in medical research, business, and government who came together to discover, produce, and widely distribute effective vaccines in record time. We should also keep in our thoughts those who have lost their lives from COVID, as well as their loved ones. Strong policy support has fueled a vigorous but uneven recovery, one that is, in many respects, historically anomalous. In a reversal of typical patterns in a downturn, aggregate personal income rose rather than fell, and households massively shifted their spending from services to manufactured goods. Booming demand for goods and the strength and speed of the reopening have led to shortages and bottlenecks, leaving the COVID-constrained supply side unable to keep up. The result has been elevated inflation in durable goods, a sector that has experienced an annual inflation rate well below zero over the past quarter century. Labor market conditions are improving but turbulent, and the pandemic continues to threaten not only health and life, but also economic activity. Many other advanced economies are experiencing similarly unusual conditions. In my comments today, I will focus on the Fed's efforts to promote our maximum employment and price stability goals amid this upheaval, and suggest how lessons from history and a careful focus on incoming data and the evolving risks offer useful guidance for today's unique monetary policy challenges. The pandemic recession, the briefest yet deepest on record, displaced roughly 30 million workers in the space of 2 months. The decline in output in the second quarter of 2020 was twice the full decline during the Great Recession. But the pace of the recovery has exceeded expectations, with output surpassing its previous peak after only 4 quarters, less than half the time required following the Great Recession. As is typically the case, the recovery in employment has lagged that in output. Nonetheless, employment gains have also come faster than expected. The economic downturn has not fallen equally on all Americans, and those least able to shoulder the burden have been hardest hit. In particular, despite progress, joblessness continues to fall disproportionately on lower wage workers in the service sector and on African Americans and Hispanics. The unevenness of the recovery can further be seen through the lens of the sectoral shift of spending into goods, particularly durable goods such as appliances, furniture, and cars, and away from services, particularly in-person services in areas such as travel and leisure. As the pandemic struck, restaurant meals fell 45%, air travel 95%, and dentist visits 65%. Even today, with overall GDP and consumption spending more than fully recovered, services spending remains about 7% below trend. Total employment is now 6 million below its February 2020 level, and 5 million of that shortfall is in the still depressed service sector. In contrast, spending on durable goods has boomed since the start of the recovery and is now running about 20% above the pre-pandemic level. With demand outstripping pandemic-afflicted supply, rising durables prices are a principal factor lifting inflation well above our 2% objective. Given the ongoing upheaval in the economy, some strains and surprises are inevitable. The job of monetary policy is to promote maximum employment and price stability as the economy works through this challenging period. I'll turn now to a discussion of progress toward those goals. The outlook for the labor market has brightened considerably in recent months. After faltering last winter, job gains have risen steadily over the course of this year and now average 832,000 over the past 3 months, of which almost 800,000 have been in services. The pace of total hiring is faster than at any time in the recorded data before the pandemic. The levels of job openings and quits are at record highs, and employers report that they cannot fill jobs fast enough to meet returning demand. These favorable conditions for job seekers should help the economy cover the considerable remaining ground to reach maximum employment. The unemployment rate has declined to 5.4%, a post-pandemic low, but is still much too high, and the reported rate understates the amount of labor market slack. Long-term unemployment remains elevated, and the recovery in labor force participation has lagged well behind the rest of the labor market, as it has in past recoveries. With vaccinations rising, schools reopening, and enhanced unemployment benefits ending, some factors that may be holding back job seekers are likely fading. While the Delta variant presents a near-term risk, the prospects are good for continued progress toward maximum employment. The rapid reopening of the economy has brought a sharp run-up in inflation. Over the 12 months through July, measures of headline and core PCE inflation have run at 4.2% and 3.6% respectively, well above our 2% longer-run objective. Businesses and consumers widely report upward pressure on prices and wages. Inflation at these levels is, of course, a cause for concern. But that concern is tempered by a number of factors that suggest that these elevated readings are likely to prove temporary. This assessment is a critical and ongoing one, and we are carefully monitoring incoming data. The dynamics of inflation are complex, and we assess the inflation outlook from a number of different perspectives, as I will now discuss. The spike in inflation is so far largely the product of a relatively narrow group of goods and services that have been directly affected by the pandemic and the reopening of the economy. Durable goods alone contributed about 1% to the latest 12-month measures of headline and core inflation. Energy prices, which rebounded with the strong recovery, added another 0.8% to headline inflation. And from long experience, we expect the inflation effects of these increases to be transitory. In addition, some prices, for example, for hotel rooms and airplane tickets, declined sharply during the recession and have now moved back up close to pre-pandemic levels. The 12-month window we use in computing inflation now captures the rebound in prices, but not the initial decline, temporarily elevating reported inflation. These effects, which are adding a few tenths to measured inflation, should wash out over time. We consult a range of measures meant to capture whether price increases for particular items are spilling over into broad-based inflation. These include trimmed mean measures and measures excluding durables and computed from just before the pandemic. These measures generally show inflation at or close to our 2% longer-run objective. We would be concerned at signs that inflationary pressures were spreading more broadly through the economy. We are also directly monitoring the prices of particular goods and services most affected by the pandemic and the reopening, and are beginning to see a moderation in some cases as shortages ease. Used car prices, for example, appear to have stabilized. Indeed, some price indicators are beginning to fall. If that continues, as many analysts predict, then used car prices will soon be pulling measured inflation down, as they did for much of the past decade. This same dynamic of upward inflation pressure dissipating and in some cases reversing seems likely to play out in durables more generally. Over the 25 years preceding the pandemic, durables prices actually declined, with inflation averaging negative 1.9% per year. As supply problems have begun to resolve, inflation in durable goods other than autos has now slowed and may be starting to fall. It seems unlikely that durables inflation will continue to contribute importantly over time to overall inflation. We will be looking for evidence that supports or undercuts that expectation. We also assess whether wage increases are consistent with our 2% inflation goal over time. Wage increases are essential to support a rising standard of living and are generally, of course, a welcome development. But if wage increases were to move materially and persistently above the levels of productivity gains and inflation, businesses would likely pass those increases on to customers, a process that could become the sort of wage price spiral seen at times in the past. Today, we see little evidence of wage increases that might threaten excessive inflation. Broad-based measures of wages that adjust for compositional changes in the labor force, such as the Employment Cost Index and the Atlanta Wage Growth Tracker, show wages moving up at a pace that appears consistent with our longer-term inflation objective. We will continue to monitor this carefully. Policymakers and analysts generally believe that as long as longer-term inflation expectations remain anchored, policy can and should look through temporary swings in inflation. Our monetary policy framework emphasizes that anchoring longer-term expectations at 2% is important for both maximum employment and price stability. We carefully monitor a wide range of indicators of longer-term inflation expectations. These measures today are at levels broadly consistent with our 2% objective. Because measures of inflation expectations are individually noisy, we also focus on common patterns across the measures. One approach to summarizing these patterns is the board staff's Index of Common Inflation Expectations, which combines information from a broad range of survey and market-based measures. This index captures a general move down in expectations starting around 2014, a time when inflation was running persistently below 2%. More recently, the index shows a welcome reversal of that decline and is now at levels more consistent with our 2% objective. Longer-term inflation expectations have moved much less than actual inflation or near-term expectations, suggesting that households, businesses, and market participants also believe that current high inflation readings are likely to prove transitory, and that in any case, the Fed will keep inflation close to our 2% objective over time. Finally, it is worth noting that since the 1990s, inflation in many advanced economies has run somewhat below 2%, even in good times. The pattern of low inflation likely reflects sustained disinflationary forces, including technology, globalization, and perhaps demographic factors, as well as a stronger and more successful commitment by central banks to maintain price stability. In the United States, unemployment ran below 4% for about 2 years before the pandemic, while inflation ran at or below 2%. Wages did move up across the income spectrum, a welcome development, but not by enough to lift price inflation consistently to 2%. While the underlying global disinflationary factors are likely to evolve over time, there is little reason to think that they have suddenly reversed or abated. It seems more likely that they will continue to weigh on inflation as the pandemic passes into history. We will continue to monitor incoming inflation data against each of these assessments. To sum up, the baseline outlook is for continued progress toward maximum employment, with inflation returning to levels consistent with our goal of inflation averaging 2% over time. Let me now turn to how the baseline outlook and the associated risks and uncertainties figure in our monetary policymaking. The period from 1950 through the early 1980s provides two important lessons for managing the risks and uncertainties we face today. The early days of stabilization policy in the 1950s taught monetary policymakers not to attempt to offset what are likely to be temporary fluctuations in inflation. Indeed, responding may do more harm than good, particularly in an era where policy rates are much closer to the effective lower bound even in good times. The main influence of monetary policy on inflation can come after a lag of a year or more. If a central bank tightens policy in response to factors that turn out to be temporary, the main policy effects are likely to arrive after the need has passed. The ill-timed policy move unnecessarily slows hiring and other economic activity and pushes inflation lower than desired. Today, with substantial slack remaining in the labor market and the pandemic continuing, such a mistake could be particularly harmful. We know that extended periods of unemployment can mean lasting harm to workers and to the productive capacity of the economy. History also teaches, however, that central banks cannot take for granted that inflation due to transitory factors will fade. The 1970s saw two periods in which there were large increases in energy and food prices, raising headline inflation for a time. But when the direct effects on headline inflation eased, core inflation continued to run persistently higher than before. One likely contributing factor was that the public had come to generally expect higher inflation. One reason why we now monitor inflation expectations so carefully. Central banks have always faced the problem of distinguishing transitory inflation spikes from more troublesome developments, and it is sometimes difficult to do so with confidence in real time. At such times, there is no substitute for a careful focus on incoming data and evolving risks. If sustained higher inflation were to become a serious concern, the FOMC would certainly respond and use our tools to assure that inflation runs at levels that are consistent with our goal. Incoming data should provide more evidence that some of the supply-demand imbalances are improving, and more evidence of a continued moderation in inflation, particularly in goods and service prices that have been most affected by the pandemic. We also expect to see continued strong job creation, and we'll be learning more about the Delta variant's effects. For now, I believe that policy is well positioned. As always, we are prepared to adjust policy as appropriate to achieve our goals. That brings me to a concluding word on the path ahead for monetary policy. The committee remains steadfast in our oft-expressed commitment to support the economy for as long as is needed to achieve a full recovery. The changes we made last year to our monetary policy framework are well suited to address today's challenges. We have said that we would continue our asset purchases at the current pace until we see substantial further progress toward our maximum employment and price stability goals, measured since last December when we first articulated this guidance. My view is that the substantial further progress test has been met for inflation. There has also been clear progress toward maximum employment. At the FOMC's recent July meeting, I was of the view, as were most participants, that if the economy evolved broadly as anticipated, it could be appropriate to start reducing the pace of asset purchases this year. The intervening month has brought more progress in the form of a strong employment report for July, but also the further spread of the Delta variant. We will be carefully assessing incoming data and the evolving risks. Even after our asset purchases end, our elevated holdings of longer-term securities will continue to support accommodative financial conditions. The timing and pace of the coming reduction in asset purchases will not be intended to carry a direct signal regarding the timing of interest rate liftoff, for which we have articulated a different and substantially more stringent test. We have said that we will continue to hold the target range for the federal funds rate at its current level until the economy reaches conditions consistent with maximum employment and inflation has reached 2% and is on track to moderately exceed 2% for some time. We have much ground to cover to reach maximum employment, and time will tell whether we have reached 2% inflation on a sustainable basis. These are challenging times for the public we serve, as the pandemic and its unprecedented toll on health and economic activity linger. But I will end on a positive note. Before the pandemic, we all saw the extraordinary benefits that a strong labor market can deliver to our society. Despite today's challenges, the economy is on a path to just such a labor market, with high levels of employment and participation, broadly shared wage gains, and inflation running close to our price stability goal. Thank you very much.
You've been listening to Fed Chair Jay Powell speaking at this year's virtual Jackson Hole Summit. The notes that I'm getting from strategists so far is that this is a dovish taper. It feels like a taper. September is definitely off the table, but a very clear signal from Jay Powell that he will endorse tapering by the end of the year. Welcome to Bloomberg Markets from New York. I'm Alex Steele with my co-host for today, Francine Lacqua. Guy Johnson is off. And Francine, you're seeing that in the market, sort of a reaction, equities rallying, dollar down, but nothing massively significant in terms of assets.
Okay, let's silence these guys for a second here. So it does look very much, I think, there will be tapering. I think that one's a done deal because otherwise you wouldn't have talked at the end saying, look, we're not going to get interest rate rises. Sorry, I'm joined by my rather noisy chief financial analyst here. she's excited. She watched the speech and she thought, this is the most thrilling thing I've ever seen. There is an entertainer. Put him on Saturday Night Live. But let's have a quick look at the market here. What's actually going on? The market is pretty happy with this because he didn't move the yardstick. He basically said, not in as many words, but he basically said, yeah, tapering's going to come. But he didn't say it's going to come soon. He was very cautious, I thought. I thought he was very, very cautious. So I don't think we're going to see early tapering. I think we're not going to get it before November, which is kind of what most investment banks were looking at. So the market likes that. Sorry about all the meowing here. Lots of meowing from this little monster here. There we go. And if you're going to make that a racket, I'm going to put you on camera. There we go. See, she does all the research around here and she interprets all the facts and data. So always do your own fact checking, guys. The bond yield is down substantially, 1.26%. Let's have a look at the stock market. This here is mostly growth stocks, what I've got on the list here. And what would happen? It would be taper. We would expect the 10-year bond yield to go up. When the 10-year bond yield goes up, it means that the valuation of our forward-looking growth stocks, their discounted cash flow models, go down. So it means that we lose value in growth stocks. We are not doing that here. Most of our growth stocks are looking pretty happy. The couple who are down, I think, are down for their own reasons, like some Chinese stocks and like Alibaba and so on. I don't think that's got anything to do with the market here. Everything is looking pretty green. So far, we're shrugging this off very, very nicely. And I must say, I'm very proud of every single one of you who managed to watch the entire speech, because it wasn't the most riveting thing, was it? But I think it's good to watch firsthand information in that way, really see what's going on, rather than just sort of read the two-line summary that someone butchered up on Reuters. And Glenn told Powell no rate hikes till end of year 2023. I mean, I don't even know if we're going to get them then, but it's going to be a long way off. He was basically saying we're going to have to get to maximum employment and inflation is going to have to come down to 2%. So that's some way off. What was quite interesting, I thought, was his whole description of inflation, that inflation isn't an even thing. Inflation is all about durable goods. So your washing machines, your furniture, your cars, that sort of thing. And they are more expensive because of the supply chain disruption that we have at present. And that's going to be temporary. That's going to get fixed. Whereas service prices are actually down. So this is just that one little item. You take that out of the equation, we haven't really got substantial inflation. So therefore, I think he put across a pretty dovish statement here. The market is reacting likewise, and he made it very, very clear at the end that tapering does not mean interest rate hikes. The market can absorb tapering. We might see a little bit of a dip in the S&P when it does happen, and in the Nasdaq 100. But you heard Morgan Stanley's equity strategist before saying it's a buy opportunity. It's when interest rates go up, that's a bit more of a concern, but that's going to be far off. What's the CFO names that does all your research? This little monster here is called Tallulah. She is a purebred pedigree Hong Kong street cat who is really very, very sweet. So volume declining on Palantir, but prices going up. Be careful, we ran 4%. There could be a mini sell-off, says Noah. Yes, of course, possible. There might be a little bit of profit taking, but overall, the market is looking really pretty good. Let me open a Palantir chart here, because that's what we seem to be glued to. Palantir. I still have Bloomberg in my ear, by the way. If they do say something insightful, I will share it. But at the moment, they're just regurgitating the same facts we've just heard. So yeah, lovely rally up. You guys were also asking, some people were asking, what's the next resistance line? It's 25.94. It's this Fibonacci line here. And that was also the high, I think, on the 17th or 18th. So that's kind of our resistance line we need to break through. But we are looking very nice here, above $25. I really think that could be our new support. We also have cats on our shoulders. We also have RSI down here. Let me magnify this for you, improving very nicely, right? You can see that trajectory here is a very nice recovery in momentum. So that's looking pretty good there for Palantir. A little thanks for joining in. Thanks for not interrupting, Powell. I try not to talk over people because I think I really think it's good to listen to things firsthand. It makes us a little bit smarter. It's not always the most riveting stuff you hear firsthand, but at least you know what was said, you know the context it was said in, rather than just picking up one headline. So yeah, Palantir 2580, that's pretty good stuff. 2581 by the second ticker here. Coin is also up. What does that mean? Does that mean Bitcoin's gone up? Probably, right? They seem to move in tandem. Where did my Bitcoin go? Still 48,000, up 2.5%. So yeah, that's moving up a little bit. Netflix up, Square up, Plug up, Facebook up, everything up more than 1%. So the market so far seems to be released. Bear in mind, volumes are still pretty small, but so far this is far better than what we thought we might get. We thought we might get more of a statement about how great the economy is doing. He was very, very cautious. We tried to interpret his coughs and his snivels and his sniffing and his funny noises he makes. I think he might have a bit of a cold. I think that might be the case. Feeling spendy today, bought a couple of shares of SoFi, also Neo, says Cyrus. Cyrus, thanks for sharing. I think I might also be doing some shopping today. Interesting day for it. After the call, I'll do it. I'll share it with you guys on the Discord, of course. As always, we've got a little channel up here, Felix's Trades. Not that you should follow my trades, but I think for transparency, it's good to share it. If you want to join our Discord, click on the Patreon link below. It's 50 cents a day because I want to keep it small and lean and research-based. And I have people on there who are discussing facts rather than just shouting to the moon all the time. Tom was holding him hostage under the premise that he actually runs the economy, says the end of the drug war. Yeah, Tom seems to have come and gone. He's just did a drive-by basically to throw a little bit of China love in our direction. And Cuba cleared crypto, says Lost Sailor, after El Salvador. Currency we will be fill in the blanks. Is that really true, Lost Sailor? I haven't read that yet. That would be quite a story if they are also using that. I suppose to remove dependence on the US dollar, which seems most of Latin South America seems to run on. So the market is looking pretty marvelous. Look at this here. The Nasdaq up almost 1% now. S&P, Dow Jones up. VIX is down 5%. Sorry, I say see, you can't see it, but VIX is down 5%. That means volatility is down. That means we are not so worried for the next 30 days. Nasdaq up here 0.9%, S&P 0.7%, Dow Jones 0.62%. Let's have a quick look here at 10-year bond yield is down, which is good. And look at the headline that Bloomberg is carrying here. Tapering doesn't carry direct rate hike timing signal. So he got that message across very well. So very good that they're picking that up. And PayPal chat is responding well. Absolutely. Do you or anyone else on this chat have any thoughts on PSFE? I haven't so far, but I'll gladly look at it. FR8, welcome to the chat here. Tom Nash is the man behind the curtain, the man behind the iron curtain, perhaps. Have you done a summary of the Fed's meeting? Okay, let's do a quick recap here. So essentially, he gave a very balanced speech, virtually without any emotions. The man has obviously trained himself to not give any emotions, so he does cough and sniff at times. He essentially said that we've had substantial improvement in employment, but there is still a big gap there. And he said the concern is when people are long-term unemployed, it has a big damaging effect on those people, and that's not the intention here. And he stressed that pre-COVID there was a huge benefit of near full employment. He also talked about inflation, and he broke it into two parts really. He said the service sector, actually the inflation numbers are pretty low. They're 2.7% or something like that. It's durable goods where over the last 20 years we've had negative inflation. That is where we're seeing those 7-8% inflation numbers coming from. And why is that? Because people stopped spending money on services because they couldn't go out, they couldn't go to restaurants, they couldn't enjoy themselves. And therefore, they sat at home and they thought, we've got time, we're working from home, we've got money because we're not spending money on services. So let's buy a washing machine, let's buy some furniture, let's buy a new car and so on. And at the same time, we've had the COVID-caused supply chain problems, which increased the prices of those and narrowed supply, increased demand. So he's saying that is an anomaly that is going to go away because washing machines haven't gotten more expensive suddenly, right? This is a short-term thing. They're going to get cheaper and cheaper over time because of advances in manufacturing and so on, and globalization. That's basically what he was saying. So he kind of explained away the inflation worries there. And he also stressed that they've done a good job, which is sort of what he wants to do. But he was very careful to balance this with the employment story. He did make it clear that he thought it was improving, and that they thought the inflation was under control and that employment would likely continue improving. So he then said at the end, but tapering doesn't mean interest rate hikes, essentially. So tapering is going to come. It's not going to come sooner than expected, but it is going to come. So I would put money on, I'd put about $1 on it starting in November, possibly December. But 50 cents on December and $1 on November. That's my massive bet here for the day. And they're then going to start phasing that out. So we might in September, in that Fed meeting in September or in October at the latest, I think, going to get a timeline for this, provided the employment numbers and all other economic numbers keep pouring in the same way. So this was a very balanced approach. End of the drug war is the drug war today there. Thanks very much for your support. Much appreciated. I would also appreciate your likes just as much. So just smash that like button, guys. It's easy. It's free. And speaking of free, I do this, guys, actually to share educational information. I think we all need to know a little bit more about how we invest. So why don't you go to my website and download here this free step-by-step guide to boost your investment returns. It's a 7-step process. It also has a video that comes with it that explains it. It's entirely free. So why don't you go and check that out? My website is goatacademy.org. That is not because I have sort of ideas of grandeur about myself being the greatest of something. It's because we donate for the goats. For every one of your likes, I donate 1 cent to the Gentle Barn. Lots of goats there. That's sort of how this madness got started. So check that out. Thank you, FR8, for smashing the like button. I appreciate it. So overall, I think this is as good as this could have been. This is much, much more positive than I thought it would be. I was a little bit cautious on this the beginning of the week, because normally when Powell speaks, the market freaks out. But so far, the market is doing the opposite. Let me just show you again here the ticker. Let me see if I can magnify this a little bit for you guys. Rivian, by the way, filed for an IPO just. Have you seen that? That's interesting. Let me turn that on.
This is a market that has an insatiable appetite for companies, it seems like, when it comes to the capital markets. It is a lofty valuation, especially considering that Rivian, like everyone else in the pack, hasn't actually done anything yet, right? They haven't built a single vehicle for sale, made no deliveries to customers. They faced multiple setbacks, largely because of COVID-19 and supply chain disruption. But what my sources tell me is that investors really see Rivian as the main challenger, potentially, to Tesla. They take a very prudent approach. They've invested very heavily in their plant in Normal, Illinois, as we have broken stories on over the last few months. They're already looking at expansion in both Europe and the United States. And the product that they want to bring to market, this battery electric pickup and big battery electric SUV, is much more in line with what Americans are buying in terms of their day-to-day vehicles. So there's a lot of excitement around the company.
I mean, $8 billion, Ed, is such a huge amount of money. They're also backed by Amazon and Ford, so that must help.
Yeah, and that's the diversifying factor of their business versus Tesla, for example. They have this contract with Amazon to build 100,000 delivery vans by the end of the decade and 10,000 of them by the end of next year. They're on a really hard timeline, but that is a very different kind of business arrangement than introducing a brand new consumer product to the market and then, trying to ramp up your
Bova EV there. You said you hauled an Amazon van for them a month ago. Share some more. That would be really interesting. I'd love to know. So you've actually been in one of these vans? Have you driven one of these vans? They exist. They are real. I'd love to hear that story. If you want to drop me an email as well, I'd love to hear about your perspective. That, of course, also goes for anybody here. I'm going to put my email in here. goatacademy.org. Drop me a line anytime, any questions you have, and anything vaguely investment related. I'd love to hear it. That's an interesting one. But yeah, 80 billion valuation, that's pretty substantial, right? I mean, what's NEO valued at the moment? Let me pull that up here. NEO stock market cap is 62 billion. So they are getting... Well, they're getting the American bonus here. I think that's really what they're getting. But yeah, it's a pretty lofty valuation. FR8, Barber is down. Well, Barber is down. There's this new regulatory issue. Basically, there is an algorithm sort of law coming out, possibly, that might prevent them from sort of meddling with their search results. So that is why they're down. They were down in the Hong Kong too. But at the moment, the market looking, apart from Alibaba, looking pretty fantastic. Plugs up, Hillian's up. You'd think that Tesla is also up. Yes, actually, the Rivian story might help them too, lift the whole EV sector, really. Look, NEO is moving towards the zero mark here as well. They were down a bit as well. So 100,000 in 10 years, Tesla makes 50% of that in 1 month in Giga Shanghai, says Desmond. Very true. But I suppose as a sort of supporter investor, Amazon there is doing what they can to kind of give a near guarantee on orders, which lifts valuations, makes it easier for them to raise money and so on. So I can see why they're doing that. It's kind of the smart thing to do. My categories. But yeah, interesting. Anyone going to buy that? I don't know. We might going to have to do a deep dive on Rivian's valuation and what that's really all about when that comes out. That might be a little while when that comes out, but I'm going to make a note of it here. Do a Rivian IPO story. I think that's going to be really interesting to see what their numbers are, what their plans are, and so on, and how that compares to Lucid, Tesla, and everybody else in this space. FR8, did you hear about China potentially banning data-rich firms from IPOs in the US? FR8, yes, I told you about this, I would say 3 days ago, I want to say. There is a Chinese sort of national security data type piece of legislation out. And if you want to IPO, you're going to have to get approval for that, basically. That's all it's saying. It's not banning it. It's just saying you're going to need to get approval. And that fits in with the whole VIE structure, right? The reason we have VIE structures is because there are parts of Chinese companies that are not allowed to be foreign owned or wholly foreign owned. And that's why these VIEs get set up. So it all makes sense. This is to me, this is a check and balance approach by the Chinese regulators to make sure a DD does not happen again. So Nicholas, I think Tom's wrong on that. I think it's the opposite. They want to screen IPOs because they do not want another DD. And for that, the IPOing companies are going to have to show the Chinese regulators that they comply with all laws, and they're going to have to get sign off. And only then can they go and actually list overseas. And that makes a great deal of sense because that regulator actually understands Chinese law. The SEC doesn't. So the SEC can't comment on whether or not, say, DD complies with Chinese law. They got no idea. So I think that's a good one. To me, that's completely reasonable. But it's, look, there is always an impact on Baba. For some reason, everything gets stuck to Baba. That is vaguely bad news, Chinese related. So the thing I think that's affecting Baba is more the algorithm law. So they are putting out this regulation or getting opinions on it, whether or not you can sort of manipulate your algorithm. So think about search results, right? We've had this conversation a bit with Google or Facebook. Google basically determines what shows up, right, on page 1. Now, if you manipulate that to favor certain companies, that would be unfair. If you are Alibaba, you are probably doing that. You probably are favoring your bigger merchants, your better merchants, the merchants who are paying you more in advertising revenue and so on, at least potentially. So that's really the question there is how much that might then affect revenues, really, or how they can position those favorable merchants of theirs. I suppose they could just use adverts to do it, but certainly there is going to be some impact there or some digging into that. And F8, you're right. Baba does get the backlash for everything. Well, it's the one Chinese stock that most people can name, and therefore everything vaguely negatively related to China gets stuck on there. You might have seen this earlier. I did share this earlier on the Discord before the call here, because somebody was asking exactly the same question, and I posted it somewhere. Where did I post it? I think under the Chinese stock chat here exactly. So we're talking about this a couple of hours ago, and I shared an article on this internet algorithm story. So if you want to come and join our community, you're very welcome to. I'll show you how you get there. There's a link below. It's a Patreon link. And yes, you have to pay for it. Why? Because otherwise we swamp it. We become another Reddit channel, and that isn't the intention. So it's 50 cents a day. You can also join it for the year, and then you get a month free. It's a marvelous community if you're interested in research and discussing and debating stuff with people. If you want to discuss and debate and not just sort of shout everything is going to go up, then it's an interesting one. Also, all of our course programs, so the options course, the stock course, and so on, all the communities are on here. And again, we discuss plans and what to do and how to invest and questions and like this kind of thing. And I answer people's questions on here, of course. So if that sounds interesting to you, check it out. You can come and join our course community down below. Master Stocks really teaches you how to build that long-term investment plan, how you can assess stocks, how you can read financial statements, how you can do your own discounted cash flow models, how you can invest in times of inflation, how you can understand what each economic indicator means and how to interpret that and to understand fully what that does to your portfolio. So I teach you all that stuff there. And then options trading, of course, is for those of you who are more active traders. So trading perhaps a couple of times a month, buying and selling. With options, you have several advantages. One is it's leveraged, but at the same time, it's lower risk. And third, you have probabilities. So you can make a trade and you know this is going to give me a certain profit with an 80% chance. And you don't get that with stocks, and particularly around events, around earnings. You can trade in an area. You can say, I don't care if Palantir goes up or down. If it moves within this $2 bandwidth, I'm making money, or the other way around. There are lots more things you can do that. So it's super interesting, I think, to understand. I think it actually also helps with stock trading or stock investing, because you just get a deeper understanding. So check it out. Build Wealth is the coupon. That's going to be around at least till the end of the week. Felix, we want to trade all day, every day. No, well, you pretty much can, can't you? I mean, more or less. It's pretty much 24 hours nowadays. Adam, thanks very much. I appreciate you being on all of our communities, really. So thanks for that. Desmond's talking about the sort of tech regulation there. Well, yeah, it's just a painful process. I mean, Desmond, I know we've talked about this quite a lot. It is a very painful process to get through. Eventually, I think it'll improve things, but it's going to take some time for momentum there to really lift off. We had Kathy say yesterday that she is not pessimistic on Chinese stocks, and that's about as much positivity that I think we're going to get out of the sort of US investment community at the moment. So I think we've done a nice little recap here. I truly appreciate you guys tuning in. Make sure you remember to go to my website and take some free stuff. My plan is always that my free content is 90% better than everybody else's paid for courses. That's the target. That's the milestone. So check it out. Go to gotoacademy.org and download, because there's lots of good stuff over there, like the free download, the step-by-step guide, how to boost your investment returns today. It's completely free. It won't cost you anything. You can implement it in one day. So do it if you want to. Thanks for tuning in. I wish you a marvelous Friday. So far, things are looking pretty marvelously green, which we love. All futures are up. Everything is up. Even orange juice is back in the green. See, orange juice was also watching Powell, which is important, guys. So thanks for tuning in. I wish you a wonderful day, and I will be live tomorrow again at the usual time of 9 a.m. That's our Saturday session. Saturdays are great because we haven't got the market pressure. We have a little bit more time to deep dive into stocks you have questions about. You can also shoot me an email before if you have a particular stock you want me to cover. I'll gladly do that. And thanks for tuning in, and see you tomorrow.